Good day, my name's Ed McFerran. The topic of this particular video is called boot. Boot is a term of art. It's nothing from the tax code, but it's a term of art in tax deferred exchanges that creates many questions in our practice, and as a result we felt that producing a video on the topic of boot is probably a good way of helping our clients and customers understand better when can one obtain some money from your transaction. Probably what reminds me most of a good story about boot is a husband and wife, older husband and wife, that came in for a consultation in our office. And interestingly enough, they had owned an apartment complex, not a huge apartment complex, for many, many years. The question came up from the wife, Mr. McFerran, is there a possibility that we can get money from the tax deferred exchange transaction without having the transaction fail? I immediately told her yes, but her husband interrupted and says, no, there's no way that we can get money from the transaction. And I had to correct him that it was possible that clients can get money from a tax deferred exchange transaction without causing the exchange to fail. Interestingly enough, I think what causes me to remember this is that she bent over, and underneath the table was a large binder from a local travel agency, and it was a Panama Canal cruise. She lifted up the binder, looked at her husband, and says, I've helped you clean all the painting and cleaning and fix up of this apartment complex for the last 19 years, and this gentleman says, we can at least go on a Panama Canal cruise. Well, at that time I thought it was my opportunity to leave, but upon coming back I found out that the parties had decided to take the Panama Canal cruise, but not necessarily to use money from the tax deferred exchange, but they could have. Boot is a term that comes to us, interestingly enough, from the congressional record that says clients are receiving money or other consideration from a transaction but not allowing it to fail. In most cases, there are 4 time periods of a tax deferred exchange to which a client can obtain cash. The first time period would be at the closing of what we call your relinquished property. This is the property that you're getting rid of, and in that particular instance, you could have money come to you at the closing of that transaction without causing the transaction to fail. However, you need to know that the money that you receive from the transaction at the time of closing, this boot money, is going to be taxable income, and you'll need to talk with your tax preparer as to what that tax cost is going to be. In other words, the transaction, the exchange, doesn't fail, but you need to pay a portion of the capital gains tax by virtue of receiving cash money. Just to be complete, when are the other 3 times that you can obtain money from your tax deferred exchange, again this boot? One time period would be on the 46th day after your transaction for relinquished property closes. If you do not declare any properties, all the money out of your exchange account flows to you on the 46th day because your exchange is no longer in force and effect because you didn't declare any replacement properties. If, however, you did declare replacement properties but were unable to acquire those replacement properties, it happens, then the money would stay in the exchange account until the 181st day, and upon the 181st day the money would come out of the account to you, and those would be boot dollars because you would not have completed any acquisition of replacement properties. There's one other time, and that's whatever money is remaining in your exchange account after you have acquired all the properties that you declared in your 45-day declaration. If, after you've acquired those properties and there's a property or money left over, then those monies would come to you on the day after the closing of that replacement property. Boot comes to us in a variety of fashions, and I think it's important to understand that many parties out there today believe that in order to have a qualified tax deferred exchange, you must acquire a replacement property equal to or greater. That's pretty common. It's not true. Let me say that again. It is not necessary for a client to acquire a replacement property equal to or greater than the exchange value of your relinquished property, you can still have a valid tax-deferred exchange, but you can have a valid tax-deferred exchange without acquiring a replacement property equal to or greater. What happens? Let's use an example. Let's pretend that you are relinquishing a property with $100,000 of value. We won't get into the details of closing costs or anything like that. We'll just keep it as a raw $100,000. Let's assume that you are acquiring a property for $80,000. We call that the replacement property for $80,000. It would appear at first blush that you may have a failed tax-deferred exchange because you didn't acquire a replacement property equal to or greater than the relinquished property, when in fact you acquired a replacement property, but it wasn't equal to or greater, it was actually less. Do we have a bona fide, qualified tax-deferred exchange? Yes, we do. We really, truly do. However, we're going to pay capital gains tax on the difference to which we didn't complete the exchange, or in this case, $20,000. We call this boot by value. So you can have boot in cash, you can have boot by value. Boot can show up in a variety of ways in your overall transaction. This video is intended to give you a little bit of an indication of how boot applies to your transaction. It's mainly intended to help and assist you in making a decision as to whether or not you want to have some boot in your transaction. But it doesn't replace the qualified folks that we have on our staff. Our staff is full of folks that are able to answer your specific questions, go over your specific fact pattern. This video, of course, hopefully augments their comments to you, but doesn't replace the quality information that we can provide to you on a one-on-one basis. So thank you very kindly for listening to this video on boot. Hopefully it helps and assists you to understand this particular subject associated with your tax-deferred exchange. Good day.